If I were to strike off my whole $300,000 investment portfolio, this is what I do to start investing from scratch in 2025. The first thing I would do is set my investing plan and goals. Do I want to invest for 5 years and then sell and use the money to start a business? Or do I want to invest for retirement and have a 30 years investment horizon? Or maybe I want to make as much money as possible as quickly as possible. In general, the faster I want the money to grow, the more I'm going to have to move into risky investments. My personal philosophy is investing for the long term, which by the way works magically even for the short term. So I always suggest this long-term thinking. So I would set my investing strategy for endurance. Endurance is for me the ability to keep following my investing strategy with consistency for a long period of years, regardless of the short-term outcome. Besides this, my goal is to achieve a portfolio value that allows me to live off its returns without having to work another day of my life. This is what people call FIRE. Financial independence, retire early. I want to emphasize that starting with a small investment to gain confidence is extremely important. If you start investing by opening a brokerage account and making your first investment, you already made 50% of the work. The hardest part is to begin, because you don't know the investing world and you're afraid to lose all your money. But if you do start, you're going to find out that it's actually not so hard and you're going to get used to it right away. I remember when I first started and I made my first $100 investment, I was so thrilled, kind of afraid, and I was always looking at the app, worrying that something bad would happen. Well, now investing $2,000, $3,000 or $4,000 in a stock is something I do with my eyes closed. Investing is like driving a car after you get your driving license. At the beginning, you're going to make a lot of mistakes and scratch the bodywork. And that's why, just as when it comes to a car, it's better to start with a low budget one, when investing, it makes sense to start small. There are endless psychological benefits to watching your portfolio grow and learning from small mistakes before scaling up and investing a lot of money. And that's why I always suggest new investors to never start investing with a lump sum, even if they have it available. If you have, for example, $4,000 saved and you want to start investing, I would still suggest you start with $200 per month to gain experience. The next point is to decide how much I'm going to have to invest every month to get to my financial goal. To do this, a good starting point is the 4% rule, which says that I can live off my portfolio forever with a probability of running out of money close to zero if I withdraw not more than 4% from it every year. So, how does it work? It starts by calculating how much are my actual yearly expenses right now. Let's say I spend around $40,000 per year. Then I multiply $40,000 by the magical number 25. And I get $1 million. So $1 million is a portfolio that I need to have so that I can withdraw $40,000 every year, which is 4%, without ever running out of money. And this is because the portfolio will almost always produce more than what I spend. To give you a proof that this method works, let me introduce to you a platform called FiCalc.app. If I set $1 million portfolio, 100% in stocks, and I withdraw $40,000 per year adjusted for inflation for the next 25 years, the app makes 129 simulations based on historical data and confirms that in 99.2% of the cases with this portfolio, I'm able to sustain such withdrawals for the whole retirement. So after I confirm that for my case, I need to have $1 million portfolio, I can now move to a compound interest calculator that I created and then I use to calculate how much I need to invest every year to achieve that portfolio. This calculator is available for free to all of you. You just need to click on the link in the description below, and if possible, be nice and drop a beautiful like to this video to support my work. Now, we have two ways to calculate how much we need to invest. The first one here is based on how much we can invest, and the second on how many years we have. With the first method, we decide first how much we can invest per month, and the tool tells us how long it's going to take to get to our goal of $1 million. While with the second method, you define for how long you want to invest, and the tool tells you how much you need to invest per month in order to get to that goal in the period of time that you defined. Let's use the second method today. We enter, first of all, the initial capital, and since I'm starting from scratch, let's say I have $0. As annual rate of return of my investments, I'm going to take 10%, which is the long-term return of the stock market, of which we'll talk later. My goal is $1 million, and I have, let's say, 25 years before retirement. So $754 is the amount I should invest every month to get to $1 million in 25 years. Let's say that I can invest not more than $500, so this is my limit. I can use the other table here and write $500, and since I'm investing less, the tool tells me I'm gonna need 29 years. As you can see, I'm always talking about a fixed amount to invest every month. This way of investing is called dollar cost averaging, and it's the most ideal strategy for beginners and advanced investors, especially in a volatile market like the stock market. The reason why you want to invest a fixed amount of money regardless of how the market is doing is that you want to avoid making mistakes based on emotions. If you don't use dollar cost average, if you don't automate your investments, you're going to end up investing more when the market is going good and investing less when the market is going down. This is because we are optimistic if the market is already going good and pessimistic when it's going bad. The stock market, though, works with inverse psychology. The best moment to invest is when the market is going bad, while the worst moment to invest is when the market is going well. Market going bad means you buy at a discount, market going well means you are overpaying for it. With dollar cost averaging, you smooth out the peaks and bottoms of the stock market and manage to grasp the average long-term return. So after all of this is sorted out, now it's time to invest, so I would open a brokerage account. The process is just like opening a bank account. You sign up, tip in some personal data and legitimize yourself. From the US, you can use an app like Moomoo or Webull, while from Europe, my favorite is Trade Republic. You'll find links in the description below that you can use to get free stocks when you sign up to them. Now the question is, am I going to invest in individual stocks, ETFs, or index funds? As a first-time investor, I would avoid individual stocks, at least at the beginning. ETFs and index funds are not so different from each other because they both represent a basket that includes a lot of companies inside. The main difference is that you can buy ETFs anytime during the day, while index funds can be bought only once a day at the price they reach when the market closes. A disadvantage of index funds is that often there is a minimum investment threshold, which can be $1,000, $3,000, in some cases even $10,000, which is the minimum value that your portfolio must have, while for ETFs there is usually no limit. To start, in my opinion, ETFs are totally fine, and if you want an introduction to ETF investing, you can watch this video of mine that explains everything you need to know and that I'll also link in the description below. Before telling you what my first investment would be, I want to tell you where my first investments would go, and that is in tax-efficient accounts. These are nothing more than accounts for which you get some kind of tax benefit. There are two that you absolutely need to take advantage of: a Roth IRA and a 401k. A Roth IRA is a particular type of individual retirement account where you contribute after-tax money, but this money grows tax-free and can be withdrawn tax-free if you wait until you are 59 years and a half of age. You can open a Roth IRA in the US through many brokerages like the ones that I told you before. A 401k instead is a retirement plan offered by employers where you contribute money each pay period and your employer typically matches up to a certain amount of your contribution. Now, my first investment would be, without a shadow of a doubt, the S&P 500 index, representing the 500 largest companies in the American stock market. I personally own the S&P 500 ETF from Vanguard, VOO, which would be my first choice if I had to start again. If you want to be more conservative, you can buy VTI, which is the total stock market ETF from Vanguard that includes all companies of the American stock market. The result is going to be pretty much the same in terms of returns. If you want to be even more conservative and you want to invest in the whole developed world, go instead for VT, the Vanguard Total World Stock Index Fund ETF. Now, this is valid for US investors. If instead you invest from Europe, you choose VWCE, the Vanguard FTSE All World UCITS ETF. So no matter which one of these four ETFs I choose at the beginning, the first 6 months or year, I would just put everything I can in this ETF. I wouldn't overcomplicate things by buying other ETFs, assuming I'm a beginner. And while keeping my investing simple, I would learn as much as I can about the stock market. Since I can't tell you everything you need to know in a single video, my suggestion is you can subscribe to the channel, check my older videos, and ring the bell so that you'll be notified for future videos that come out every Friday. But I want to give you 1 or 2 simple portfolio examples for beginners that you can build for yourself. The first is the famous 3-fund portfolio, and the second is a portfolio tilted towards growth. Starting from the 3-fund portfolio, here's a graph that I made that shows you which ETFs you need to buy depending on your brokerage account. In the US, you're going to need VTI, VXUS, and BND. VTI is the Vanguard Total Stock Market Index Fund ETF and covers the whole American stock market. VXUS is the Vanguard Total International Stock Index Fund ETF and covers the international market. And BND is the Vanguard Total Bond Market Index Fund ETF, which covers the bond market. If instead you live in Europe, you need a European equivalent. Instead of VTI for the American stock market and VXUS for the international stock market, in Europe you can buy a world ETF that covers both, like the iShares Core MSCI World UCITS ETF. The second portfolio I want to present to you is based instead on two ETFs, and these are VOO, the Vanguard S&P 500 ETF, and QQQ, the Invesco QQQ Trust Series 1 ETF. The Vanguard ETF is going to be your core position and should have at the beginning at least 80% of the weight, while the remaining 20% with QQQ is meant to tilt your portfolio towards growth companies. The reason why I propose this two-fund portfolio is that in the long term, growth companies have been delivering higher returns than value companies in the last 10-15 years. But there is a consideration to make. The growth sector is quite expensive now, meaning the price of this sector in the stock market is high relatively to the real earnings that the growth companies are bringing in. So if the tech sector is overpriced now, even though I have almost no doubt that in the next 10, 20 or 30 years it's going to overperform, we can't know exactly what's going to happen next year. That's why, again, my best tip to you if you're starting investing is to dollar cost average DCA the same amount of money every month into a broad-based ETF like the S&P 500 and nothing else, regardless of how the market is going. One thing you can be sure of, and I proved it with my own research with historical data, is that it's not worth it trying to wait for the market to crash before starting investing. In other words, timing the market is useless and it's always good to start right away. If you still have doubts and you say, well, maybe I should wait and see what happens with the stock market next year, then you absolutely need to watch this video, and after this you won't have any doubts that you should start now. To conclude, if I had to start again from scratch in 2025, I would surely avoid many beginners' mistakes that I've made in my past. Among them, I used to try to beat the market by buying individual stocks without research. I tried to time the market by not investing for months and months, just waiting for a market crash that never came. I didn't sell losing stocks because I was hoping to get back what I invested, which is called sunken cost fallacy, in case you want to research it. I didn't diversify through ETFs, I wasn't patient, and I never subscribed to my own YouTube channel, because I can't. But you can. So if you haven't done it, and I could help you in any way with this video, click that subscribe button down there and you'll have access to hundreds of videos about investing and finance, simply explained by the Italian twin of Manu Ginobili. Alright, beautiful people, thank you for watching, have a great evening, and I'll see you in the next video. Ciao!